Hey guys, Frank here and welcome back to the New Vision channel where we talk about all things real estate. Now our goal with this channel is about learning and sharing sound principles of starting and growing a viable real estate business or any other business for that matter. In this video, we continue the series on real estate bookkeeping. And some of the things we are going to share in this video assumes that you are familiar with previous videos. If you are new to the channel, you can follow the preceding videos in the playlists shown. In part 8 of this video series, we covered the income or profit and loss report, which is one of 3 main reports you want to get familiar with in order to understand and better run your business. In this video, we are going to continue with the cash flow report. Since cash is really the lifeblood or oxygen that your business needs to operate, the cash flow report then is really important in telling whether your business has the financial staying power to continue to operate in the short and long terms. Much like the income report, the cash flow report also covers a fixed period of time, typically a month, a quarter, or a year. But unlike the income report, that focuses on only 2 streams of money flows for the business, the income and the expenses, the cash flow report looks at all cash movements within the business, the emphasis being on actual cash movements. And there are many different flows within the business that would cause cash to move around. These can often be grouped as 1. The operations, 2. Investments, and 3. Financing. The operation side of things is much similar to the income statement in that it looks at the operating activities of the business. In other words, the cash income coming in from selling its goods and services, and the cash expenses that the business needs to spend in order to keep its operations going. A very similar concept to the income report, except that in this case, the focus is solely on the cash part of these transactions. The investment component of the cash flow statement looks at the cash that might have been deployed to acquire new assets for the business. For example, spending some of the business's cash in the bank to acquire a new building would be included in this part of the cash flow report. The financing part of the cash flow report looks at where the business is getting or spending cash to keep its operations going other than the cash that it generates from its income. There are typically only 2 ways cash can come into or leave the business. That is either through the liability or the equity checkpoints. From the liability checkpoint, cash can come into the business as a loan, such as through a mortgage or a credit card. Similarly, cash can leave the business as a payoff for the mortgage or the credit card. The cash flow statement will capture these transactions. From the equity checkpoint, cash can come into the business as a cash capital contribution or stock purchase by the owners of the business, and cash can leave the business as a cash withdrawal by the owners of the business, which is often equal to a dividend payout. Once again, the cash flow statement will capture such transactions. I recognize that the income report and cash flow report can appear to be confusing, but the key difference to remember between the 2 are: first, the income statement only looks at the income and expense categories, while cash flow report looks at cash transactions that occur for both income and expense, as well as assets, liabilities, and equity. The income statement can include non-cash transactions, while the cash flow statement has only cash transactions. These 2 reports obviously are related in some way, since the income report already includes cash transactions that affect the income and expense categories. In fact, Some companies actually show their cash flow report as adjustments to the income report. That is, starting with the income report, one can first remove or add back the non-cash transactions for income and expenses, and secondly, add the cash transactions for liabilities, equity, and assets to arrive at the cash flow report. At the end of the day, the goal of the cash flow report is to determine, for the period that it covers, what the starting cash balance at the beginning of the period was, and to it, add all the cash that flowed into the business and through what means. From this total, it subtracts all the cash that flowed out of the business and through what means. The remainder is the cash that is left over at the end of the period for keeping the business going. As a business owner, you are usually able to estimate your cash needs for the short and long term with good certainty. If at the end of the period of running your cash flow report, you determine that you have enough cash reserves to cover the short and long term needs of the business, then all is well. If on the other hand, you find that you are going to fall short, then you need to start thinking about other ways of raising cash to avoid your business going into default. In real estate, it's often not easy to raise the income level quickly. So in the event of a cash shortfall, your most likely solution is through borrowing or injecting new capital into the business. Either way, it is good to know this information well in advance of a problem showing up because of it, so that you can do something about it. And the way to know this is by running your cash flow report periodically to make sure that your business is cash healthy and in a position to continue its activities. In the next video, we will look at the balance sheet and what it says about your business. Please let us know in the comments below if you find this type of content helpful. You would be encouraging us to create more by clicking the like button and subscribing to our channel. And while you're at it, please click that notification button so that you will immediately know when we put out new content. Many thanks, and see you in the next video.